Sticking with the cattle theme, livestock producers already weathering the storm of COVID disruptions and a historically brutal winter can add higher feed costs to the list. They're getting squeezed by the highest corn and soybean prices in 7 years. That's resulted in an average increase of 30% or more to keep those herds fed. University of Missouri Ag Economist Scott Brown joined me to discuss ways to manage those higher feed costs and pricing opportunities through 2021.
There are a lot of things that are moving in the right direction for us, I think, Troy. You look at the supply side and take year-to-date slaughter for a minute. Cattle slaughter down 5.5%, hog slaughter down 4.6%. That's a very different situation than we were in much of 2020. And so supplies are slowing down. I think weights are getting in better shape for us in both cattle and hogs. We're not back to previous year levels yet, so we still have to worry about those weights. But by and large, we're in much better stead on the supply side. And as you allude to, I think there's some great demand opportunities coming for us.
Then, Scott, when we look at the export side of things, looks like good opportunity there for beef in particular.
Yeah, absolutely. And I want to remind us, so I think it's too easy to talk about China right away, and I don't want to downplay the role China can play. You know, we've been seeing weekly beef shipments to China in that 1,500 metric tons a week, which is much more than we would have seen, yet still a pretty small drop in the bucket. So I don't want to downplay China. However, there's other things at play here, I think, on export markets. Number one, just the recovery of a number of countries from COVID-19, or at least beginning the recovery. I think that equates to some stronger beef demand. You look at Mexico, Canada, even South Korea. I think we saw some periods of time where we saw stronger beef demand, and I say that has a lot to do with just recovery or beginning of recovery from COVID-19. And let's not forget the dollar has certainly weakened relative to where it was March of 2020. And that makes our products less expensive to other customers around the world, and I think could just drive demand higher. Now, I'll come back to close on China here to say the Chinese want a lot of U.S. beef from us in 2021. That will pull prices higher.
And you know, I feel like producers are going to take good news anywhere they can get it, because you've got the higher feed input costs due to that grain rally, and that's just making margins so much tighter. Is there any type of strategy that producers can have here?
Well, I often tell them they should have bought their feed back on August 1st of 2020, Troy. That's the really good strategy. My hindsight's good, I guess I will say. But however, to where we sit today, number one, I remind them two things here. Number one, supplies of crops got shorter here in the United States as what we put in the bin last fall continued to dwindle as yields weren't as good as we anticipated. So the supply side's at play. On top of that, strong demand from China. Some of that's related to the regrowth of their hog inventory. So we have both supply and demand that's driving these higher prices. For me, for risk management for livestock producers, you know, we're going to start to see acreage estimates. USDA gave us 92 million acres of corn and 90 million acres of soybeans to be planted this year. I think some of those could at some point make markets for corn and soybeans move lower. I think we just want to be able to take advantage of those opportunities. At the same time, once we get out into June or July and we start to see what this crop's beginning to look like, if it looks like a good crop, that may give us some opportunity to do some price risk management on feed costs. At the same time, if we get out in June and July and we have another very tight or tough yield year coming, we don't want to be caught as livestock producers not being prepared for that outcome as well. So a lot of volatility with what are 1.5 billion bushels of corn ending stocks, according to USDA at the end of this year, and 120 million bushels of soybeans.
And Scott, let me get a question in about the cattle on feed report that came out at the end of last week. I know there were some surprises there. Is there anything you want to take us through and break down for us?
Yeah, so I guess for me the big issue here is when you look at cattle placed in January, you know, we came in at 103.2 relative to a pre-report midpoint of 99.9. We actually fell outside the upper end of the range, so more cattle placed than we would have thought. That doesn't always necessarily correspond with the cattle report we would have gotten a month previous that would have said a revision of 2019 calf crop down roughly a little less than 500,000 head, and then a new estimate for the 2020 calf crop that was roughly 600,000 head lower than what their original estimate was in July of 2020. So fewer calves according to that cattle report, yet we continue to see pretty large placements. I hope we don't continue that as we move forward, but it is the one side of the supply puzzle that we want to watch the next couple of months here as we get more cattle on feed reports in front of us.